The Honest Money podcast is powered by 10x Investments, a licensed financial services provider. Consult with your financial advisor and let's 10x your future together.
Welcome to Honest Money. We're talking about an interesting topic today because we're going to talk about something which might seem very strange to those of us living in South Africa, at the tip of the continent. And we're going to be focusing on the US bond market, the American bond market. And I can claim very confidently almost zero knowledge about the US bond market. So I'm going to have to bring in an expert, and I'm very glad to have Anton Eser. He's the Chief Investment Officer at 10x Investments to talk about this. Thanks so much for joining us again, Anton.
Thanks, Warren. Great to be on the show again.
So I think it's something that we kind of, get a lot in the news. You'll hear about it on radio shows. The financial publications will often talk about the bond market. What I know about bond markets just in general is that they're multiples bigger than stock markets, and that's just a general principle. But I'm never quite sure why we sit here in the tip of Africa in a tiny little continent worrying about mining and elections and politicians, and then the media are blabbing on about the US bond market. What on earth has that got to do with us?
Yeah, Warren, you're spot on. I mean, it's a long way away, firstly, geographically, but it's super important. In fact, actually, for every financial asset on the planet, really, right through from housing through to equities, etc. And I'll tell you the reason why is the Treasury market. The US Treasury market is kind of perceived as the place to go to, which is what they call the risk-free asset. So if you don't want to own any risk, the dollar as a currency is perceived as the base currency for every single currency that trades in the world. Everything trades relative to the dollar. Commodities are priced in dollars. And so the reserve currency, as it's called, is perceived as the dollar. And if you want to own the dollar, you can really do that in the most risk-free way by owning US Treasury bonds. So, the Treasury bond, really my whole career, from the 90s or dates back in terms of how important this has been. But the Treasury bond market has been always perceived as what's called the risk-free asset. So, if you're very scared about owning risk, you sell all of your risky assets like equities and you go and buy Treasuries. And really everything. So if you think about a company which is issuing debt, to fund their operations in the US, they come along to the market, issue some bonds, and they issue at a spread relative to Treasury bonds. So, if you are a highly rated corporate issuer, like let's say Apple, you come to the Treasury market and you issue that at, let's say, 1% over Treasury bonds, and then you lock in your coupon. So everything right through from corporate bonds, which are directly linked, right through to how we think about, let's say, the value in equities. What is the yield I'm earning on my risk-free, and what is the earnings yield I'm earning on equities is a reference point through to treasuries, and so on and so on. So, when we think about risk, think about everything that we look at in financial markets, it always comes back to this concept of the risk-free. And that is going to be a really important topic for our discussion today. Is it still the risk-free?
So maybe to think about it a little bit like gravity, so everything relates to this one thing. If you want to determine if a share is cheap or expensive, you can't just do it in isolation. You have to measure it to something. And especially global stock markets and in the US in particular, you would use the US. And I'm guessing it would apply the same principle would apply, for example, if you're looking at outside of the US. If you're saying, well, gee, I like for some crazy reason, I think France is the place to go now. I think, that's an economy that's going to be booming. Your alternative to France, if you would then be, well, what's the risk-free rate? And that would be US Treasury. So it gives you that absolute kind of zero level from which you then say, am I prepared to take more risk than the risk-free rate? And if I am, how am I going to be paid for it? So whether you're buying shares in emerging markets or bonds in emerging markets or property or anything, if you're a global investor, your benchmark would then be, am I paid for any more risk than just going into those US Treasuries, if I'm understanding it correctly.
No, that's spot on, Warren. That's correct. I mean, that's your first starting point, and then it kind of obviously builds from there. But absolutely, yeah.
So if that's the case, I mean, a lot of people talk about, that the US, with the US dollar being the reserve currency of the world and the biggest treasury market around, that relationship might be changing, and forever, for as long as I've been in the markets, which sounds almost as long as you, Anton, it's always been the dollar, and there's always been someone punting an alternative, whether it's the euro, then it was going to be China, and then for a little while it was going to be cryptos. It always sounds to me like people are looking at an alternative and predicting the death of the dollar as the reserve currency and the death of US Treasuries. Are we still having that debate? Is there a viable alternative?
Yeah, I think we're going to be having that debate, Warren, probably for the rest of our careers. There's a lot of reasons for it in terms of, in other words, is this something which is sustainable? Will the dollar be the reserve currency, for the next 10, 20 years or not? And I think that debate's going to continue for a while. And I think it gets complicated. There's a lot of geopolitics around this, China, Russia, as we know, and then you mentioned crypto. Back in the 70s, 80s, 90s, it was gold, and these themes are going to continue. They've been debated for decades and will continue. I think what has definitely been changing, definitely since the financial crisis, and in particular, I think in the last 3 years, which has brought this whole debate really much more to the kind of center of things in terms of financial markets and where we are, is just around two things. It's firstly around just how big the global debt to GDP, and in particular, let's focus on the US, how big US debt to GDP has become. And since COVID, that number just really went gangbusters. The days of any fiscal discipline in the US are long gone, and the number just ratchets up. The deficit just gets higher and higher. And then there's the second one, which is around what's called monetization of the debt. This is around the Federal Reserve and their quantitative easing policies, and just how much debt is sitting and owned by the central banks. In the US, same in Europe. Obviously, Japan's a massive owner of their own government debt. And so this kind of whole thing around the sustainability of the dollar, the sustainability of the treasury market. It's very difficult to predict, but every year that kind of question around sustainability is just getting more and more questioned. And as we know, with all these things in financial markets, you can never predict. You can prepare, and to predict ultimately when that does shift and change it's impossible. It's impossible to do. Financial markets ultimately will determine the direction of this. But yeah, I think it's a really important point for all of us. And I do think a lot of things in the last little while have been changing. I think a lot of times when people debate this whole issue around debt, it's quite a mixed view. A lot of people say, well, for every liability, there's an asset. So why do we care about debt? Because debt ultimately is offset by assets, and the US is a very asset-rich economy, and all these bits and pieces. So look at Japan. Japan's debt to GDP is like 240%, and it's been growing every year since 1990. And if you've kind of had a view around that being a problem, you've been completely wrong for 3 decades. So, why do we care now? I think that really is the crucial point. Why do we care now? I'm sure we'll unpack that.
Just thinking about it, Japan's a very good example of where, an economy can operate for many decades, as you're pointing out, kind of almost contrary to what the financial and economic textbooks would tell you. When they're operating at, almost no inflation, almost no interest rates, and just carrying on. And as in stock markets, kind of only really very recently, breached its high from from I think the late 80s, if I'm not mistaken, or early 90s. And so you sit in an environment where, talking about predictions, you could comfortably predict that if you live in a place with very low interest rates, that would cause people to spend more, and that would become inflationary, and that would be a problem for an economy. And as you say, if you'd had that view on Japan in the middle of the 1990s, you would have been horribly wrong for a very, very long period of time. And so it is important to know that financial kind of principles do apply, but sometimes they don't apply for a long period of time. And I'm looking at the US, and I'm thinking to myself, not to be flippant about it, but it is a country which is kind of addicted to debt, and it seemingly, if I talk to some of my kind of more pessimistic investor friends, they would say, well, America's kind of due to run out of money, somewhere around the next 9 or 11 years, because they won't be able to afford to repay all the debt, just the interest that they're accumulating on their debt all the time. That's a prediction, and it probably tells you more about the person making the prediction than about the future. But I sit here on, thinking to myself, it's probably going to become a belief or sentiment issue, that at some point, outside investors, maybe even American investors themselves, will look at the American government and the American economy and say, we think we're at the point now where this government and this country can't afford to repay its debt. And it will be a sentiment point rather than an absolute financial calculation. And if the question is being asked more and more frequently and by more people, then it tells you that sentiment is starting to shift. And I think that's the danger sign for the US bond market. It's probably not a specific pure financial measure.
Yeah, I think that's completely right. I don't know if you remember back in 2010, 2011, there was a really well-known book written called "This Time It's Different" by Reinhardt and Rogoff, two very well regarded economists, and they did a whole bunch of work, as to your point, around at what point does debt to GDP become a problem, and they did a whole bunch of financial modeling, and it's a very good book. I mean, if you enjoy economics, it's a very good book. But the reality is that a lot of those calculations have become kind of redundant, because here we are in levels of 120% debt to GDP, and it hasn't been that relevant. And I think this goes ultimately to your point around sentiment. At what point does sentiment become an issue? I think saying that, however, there is something around the maths which is super important. And if you look at a country like South Africa, where our debt to GDP is somewhere around 75%, whereas the US is 120, Japan is 240, yet there's no issues around debt sustainability in the US and Japan in terms of perspective, whereas there is one in terms of perspective in terms of South Africa. And obviously the big difference is South Africa, we're funding our debt at around 10 to 12%. In Japan, it's somewhere around 0 to 1, and the US is now around 4 to 5. So it goes back to this point that we're talking on. The maths actually becomes super relevant when your interest costs and your refinance rate goes up. That's just the way it is. I mean, in the end, debt only becomes a problem when the percentage of your revenue, if you're a corporate or an individual, which you're paying towards your interest, becomes disproportionate, and you no longer can finance your lifestyle or the economy or your company. And that breaking point is actually around the maths. And from a South African perspective, we're kind of very close to that point. And the US is really reaching a point now where their interest expenses as a percentage of their fiscal deficit is just ratcheting up significantly every single year that interest rates remain at this level. And the irony around interest rates remaining here and remaining high for a while is it means that they have to refinance at a higher rate and refinance more and more of their debt for a longer proportion of the time at a higher rate. Okay, so if you had a spike in interest rates and then all of a sudden interest rates went back down, well, it's kind of irrelevant because you've only refinanced maybe 5% of your debt outstanding. But if you have a spike and then we continue that level, let's say for 3 or 4 years, you end up refinancing 30, 40, 50%. You lock in that high level of interest. And that's basically what we're going through at the moment. We're kind of 2 years now into this interest rate cycle. The interest cost that the US is paying is going up. As long as we remain this high, then that rate's going to continue. So, this whole thing which changed post-COVID was the size, but it was for the first time we've had, since the 70s and 80s, we've had inflation, proper inflation. And for the first time, the Fed, with the government, through kind of coordinated policy, effectively created inflation. They helicopter money. They effectively went and injected money into people's bank accounts. And that created, there were a number of factors, but effectively that was the main factor around the inflation that was created. And so, beforehand, they could print as many dollars as they wanted to. They didn't really care because in the end, it never created inflation. Japan never created inflation. The US Fed, QE 1, 2, 3. COVID came along, bang, big fiscal deficits, huge QE program, and we had this huge inflation problem. And that essentially changed the rules of the game around printing money and effectively creating this kind of buffer for the bond market. And we're now sitting at this very strange point in this, whereby inflation is still quite sticky, rates are quite high, and the government is refinancing at a much higher rate. And that's ultimately why right now, compared to any point in the last 15 years, the ratcheting up of the size of the debt, the stickiness of inflation, and the high level of interest costs that need to be paid now from the government's perspective. Those two things are kind of coming together right now. And we're not really seeing that in terms of any panic in bond markets. The bond market had that kind of initial big sell-off in 2022, kind of stuck around that level of, 3.5% or 4 to 5% or so in 10-year treasuries. And we're staying at this level right now. And, to say where we go from here, that's ultimately, I think, exactly to your point. It's exactly around sentiment. And it's exactly around this whole thing around definitely geopolitics, and politics is going to be important for that.
Yeah, and I think you're touching on the probably most relevant point for now is, if we were doing a personal finance consultation to someone who's got too much debt, what we would be telling them is, listen, stop taking on more debt. You've got to start, resizing your budget, spend a bit less. If you can't increase your revenue anymore, then what you can do is you can control your costs and reduce your costs so that you can pay down your debt faster. And that, that would be very simple advice to give a human, and certainly, the right advice to give the Americans, the American government, is stop spending so much, and stop wasting your money on things that are not good for your economy. But we all know that the US operates in a very dysfunctional system where, anything that someone wearing a red tie, a Republican, says will be immediately countered by someone wearing a blue tie who's a Democrat. And so they're in an environment where it would almost be political suicide for them to stop spending, to reduce their spending. The voters won't vote for that. And so it's an interesting situation where you've got, the American governments, all of them, happy to spend, we're not going to try and give a political prediction, but I'd love to know what your thoughts are on, if we're sitting in December 2024 with President Trump, what does he do in a situation like this?
Yeah, well, we do have pretty clear, a fair amount of clarity around what would happen, and because he's obviously been in the seat, and we know also a lot about what he's saying in this campaign trail. Is when Trump first had the presidency, he cut taxes, corporate taxes, substantially, to a very low level, and though that tax bill which was passed expires next year. So the first thing he'll do, alongside, the Republicans of the House and the Senate, is he'll get the tax bills, get the tax bill extended. So he'll keep corporate tax rates incredibly low. Will he cut them more? Hard to, that's going to be very difficult, but anything's possible. So I think what you can expect is a continuing policy around kind of, very loose fiscal policy coming out of the US in terms of maintaining that deficit at kind of 7%. I think the bit which is different, because I mean, look, Biden's done that for the last 3 years anyway, so we haven't got somebody on the other side who is being fiscally disciplined. The potentially difference, the difference here with the Trump versus Biden is much more around the geopolitics than the domestic politics from a debt perspective. I think the debt perspective between Trump and Biden is probably similarish. It's really around the geopolitics, and we've obviously seen Biden start to talk around tariffs, and he's done a few recently, around renewables, which was quite ironic. But Trump is a different level of protectionism. And that kind of geopolitical situation it's relevant for many reasons, inflation, all these bits and pieces, but it's very relevant in terms of this whole point we're discussing around the dollar. And China has traditionally held a significant amount of treasury bonds and dollar-based assets, and that's been a big part of the way they've managed their currency. But a geopolitical situation, we're starting to see China reduce their dollar holdings. It really brings into tension a financial system which is heavily dependent on the dollar as a reserve currency. If we continue to see fragmentation in terms of trade, in terms of kind of a geopolitical issues between the US and China, then this whole kind of financial system around the dollar being the reserve currency, treasuries being the risk-free asset, it starts to continue. It just escalates the risk around that kind of the fragility of that system being maintained as the status quo. So I think that's probably more the difference around Trump versus Biden than it is around domestic fiscal policy being massively different. Both of them, or both parties, are going to go be as fiscally expansionary as they have been, and they've proven now for a long time, really.
So Anton, this is honest money, and eventually we bring this back to what do we do in a situation like this, in this kind of an environment, if we want to take an investment nugget or two out of this kind of a conversation?
Yeah. Okay, it's a tough one, Warren, because I think it's important we kind of just establish the basis here of the issue. Firstly, on the one side, what we're saying is that treasury bonds, to this risk-free asset, is yielding 4.5%. Its real yield is close to 2.25%. It's the most attractive it's been in 15, 20 years, and definitely relative to equities, it's very attractive. So the valuations in the treasury market are very attractive on a historic basis. And in the environment whereby we have a global recession, and a drop in inflation, the demand for treasury bonds is going to be, holding all else constant, going to be very high, and therefore bonds are actually a very attractive asset class. So you've got this kind of like anchor over here, which is saying, own me, because bond yields are very attractive. On the other side, what we talked about today is that you have this huge fiscal sustainability issue, which is coming out of the US. You have a lot of geopolitical situations with liquidity issues, which we haven't really gone into, but a lot of reasons why actually the US bond market has kind of reached this new point whereby there's just so much supply and there's so many questions around sustainability. Does actually that swamp everything else? And in that environment, obviously, if there's lots of supply, not too much demand, then yields go up. And I don't want to complicate it for your listeners, but it's really important that we understand that these are two very different environments, okay? And ultimately, the decision needs to be made around which of those two is going to be the highest probability. So the way to and it's very hard to do that, because in the end, it's all around sentiment, and forecasting and predicting is very difficult. I would say, and definitely just in terms of how we positioned, maybe that's a way to kind of answer the question, because in the end, you can say all these things, and it's what do you actually own that matters. We do own a lot of dollar cash. Cash yields are very attractive, and you don't have any volatility through movements in yields. So cash is actually the only diversifying asset class apart from things like gold. So we do own a lot of dollar cash. We are actually, in the end, of the view of the view that it's more the risks around we're very late cycle in the global economy, and hence a slowdown in growth and a drop in inflation is a more likely scenario. And therefore, owning duration in our bond portfolio is what we do. So we are actually overweight duration. So actually, despite everything I said, in the end, the anchor, which is around low levels of inflation, is more of a pull than what we've discussed here today. But overall, and I would say this kind of the risks, and we spoke last time on your podcast around valuations in the US equity market, and the risks here around debt sustainability in the US really tells you that overall owning risk is something which, this is the time to be defensive in all of your multi-asset portfolios by owning cash and bonds, and just being very careful and prudent globally in terms of the equity allocation. And that's how we position. So we underweight US equities, overweight US cash, and just marginally long US bonds. For investors who can, gold is a very good tail hedge against this scenario. It's been doing relatively well, but there's a lot more potentially in there for gold. Gold, that's obviously good for South Africa given the amount of gold exposure we have. But there are asset classes which can kind of provide that type of a hedge that I mentioned, against the scenario I mentioned before, like gold. But simplistically, overweight cash, kind of marginally long bonds, and underweight equities.
Anton, that was very, very interesting and also very useful. Thank you very much, Anton Eser from 10x Investments. I think, if I think through what Anton was talking about, the world is an enormously complex, system, and you can get lost, in the detail, and eventually you've got to make some decisions, and ultimately, proper diversification counts a lot, and not being too brave in terms of just chasing growth for growth's sake, I think is important. If you're watching the big tech companies pumping out great results, and if you believe that you allocate all your money to tech companies only, you might be setting yourself up to fail. So kind of de-risking some of your portfolio and being a little bit cautious, a little bit conservative when the world's so uncertain and unstable is not necessarily a bad decision. And don't worry too much about FOMO. This isn't a sprint; it's a very long marathon, and I think proper diversification is a real key in an investment cycle like this. So, Anton Eser, thanks so much for joining us, and we look forward to chatting to you again.
The Stradivarius violin is considered to be the most emotive instrument in the world. That's why you'll often hear it in investment ads, adding drama and the utmost importance to their philosophies, or for the announcement of a fancy new fund manager. 10x Investments don't need dramatic instruments to seem impressive. They let the results sing for themselves. So 10x your future without the drama. 10x is a licensed FSP.